Hi everyone, my name is Morgan Nash. I'm going to start out by apologizing for my voice. I'm actually really sick right now, so if the audio annoys you, feel free to just turn it off. So I did my project over the Fama and French three-factor model, and specifically I wanted to build two different portfolios, one based entirely on small cap stocks and the other based mostly on small cap stocks with one large cap stock. And what I was trying to test here was there's this idea of, or this observation that Fama and French had, that small cap stocks outperform large cap stocks. And so I just wanted to see, using their own model, how the linear regression results look different when there's only that slight change of one large cap stock in a portfolio. So I noticed everybody doing machine learning stuff. So the reason why I chose to stick with this was because if there's one thing I'm unfamiliar with as an economics, philosophy, and religious studies major, it's finance. So I really wanted to study some of the canon work in finance. So I'll give you guys a short overview. So first I'm going to talk about the Fama and French model, what's actually included in it. Then I'll talk about the outperformance of small cap stocks, as well as what small cap stocks actually are. I'll talk about how I chose which stocks were going into the portfolio and the weights that I put on them. And then I have some data visualizations that I made in ggplot in R of the stock returns. And then I will analyze the regression results and finally conclude on some insights that my research brought out. So Fama and French noticed two trends that led them to build this three-factor model. So a little bit of history: it was built as an improvement on the capital asset pricing model, because the capital asset pricing model only takes into account the beta, or the portfolio risk relative to the overall market risk. So they noticed a couple factors that influence the returns of portfolios. One of those being that smaller companies generally outperform larger companies, or small cap stocks outperform large cap stocks. There are a lot of theories as to why this actually is. I'll go into that a little bit later, but what's important for this part of the presentation is just to know that this is something Fama and French noticed in their data. And a small cap stock in comparison to a large cap stock is just generally a smaller company that doesn't capitalize on all their different assets in the same way as a large cap company. Additionally, companies with greater book value than market value outperformed stocks of companies that were the other way around. So book value is the actual accounting value of the company, including all of their assets, all their revenue, all those kinds of things, whereas the market value is the value that is assigned to that company through the market, which can be shown or illustrated through the stock price. So what this means is that since Fama and French noticed these two phenomena going on, the companies with greater book value than market value are called value stocks, and that's in contrast to growth stocks for the sake of this model. So the implication of this is essentially that investors should uniformly invest in small cap value stocks. But if investors do take that approach to investment, then the outperformance of small cap value stocks will no longer be seen, because all the investors buying up all that stock will increase the price of the stock and the returns won't be as high. So here's what Fama and French actually did to build their model. So the model includes three variables, or three risk factors, or three return factors. Those being, first of all, the market risk minus the risk-free rate. Secondly, the small minus big returns. So they just took a sample of 6 different portfolios that were based on small companies, 6 different portfolios based on large cap companies, averaged out the return for those, and then subtracted one from the other. Additionally, they take into account HML, which is the thing I spoke about earlier. That's just essentially its book equity to market equity ratio. So you would expect that the higher that ratio is, sorry about that. you would expect that the higher that ratio is implies that their book value is higher than their market value, and so on. So the empirical implications of this is that, first of all, you have the beta, which is that market risk minus the risk-free rate. And that illustrates how risky this portfolio is external to the market risk that already exists. And usually that analysis is based on T-bills. Additionally, SMB measures or takes into account the outperformance of small stocks, which is where the capital asset pricing model falls short. You would expect that a small cap equals a higher return. And finally, it takes into account the outperformance of value stocks by analyzing that book equity to market equity ratio. So the most interesting explanation I found to figure out why small cap stocks outperform large cap stocks is because this Yale chief financial investment officer, David Swensen, hypothesized that it's because large cap stocks are more likely to be correctly priced. So pretty much what you get back is what you pay for with those, whereas for small cap stocks, they can be significantly undervalued. So smaller companies are exposed to more risk factors, which means that investors don't want to buy up that stock. So since demand is low for that stock, the price is going to be low. Additionally, smaller companies just have less capital and fewer assets typically. So compared to larger companies, intuitively, you would think, okay, well, their real intrinsic value isn't very high. So their book to market equity ratio is not going to be very high. Lastly, large companies are also generally more reliable investments. This has to do in part with smaller companies being exposed to more short-run risk. And it also has to do with the probability of going out of business. If you're a large established company, you're much less likely to go out of business. So finally, you can take a look at this graphic. I have the source for where I got this graphic down at the bottom. And the article that goes along with it illustrates this relationship really well. So you can see that what David Swensen was theorizing here was that there's a greater concentration of small cap stocks that are underpriced or overpriced in comparison to those that are correctly priced. So in other words, there's good variation in the price. You can buy low when the actual value of the stock is very high. And then over time, as the company grows, you'll expect that price to get higher and higher and higher. In addition to this, the other theory I've heard for why small cap stocks outperform large cap stocks is that there's simply more potential for growth in small cap stocks. But to me, that theory didn't make a whole lot of sense, especially since statistics show that about 90% of startups go out of business. So I chose to try in some way to address this with my research, but this isn't the focus of my research. So I constructed two portfolios. I have the three large caps or small cap stocks are the ones on the left. So that would be Sonic, LTC Properties, Lithia Motors, and Louisiana Pacific Building Products was the only large cap stock that I used in this portfolio. And how I classified these was really I just looked at a ton of different financial journal articles as well as financial newspaper articles, so things like Forbes, Investopedia, all that good stuff, to see how they classified each of these companies. I weighted them all equally, and I did the same for the other portfolio just to keep things constant so that I could really isolate that the only thing that would change the regression results would be having a large cap stock in there. So I built a second portfolio that is all small cap stocks. So it's Sonic Drive-In, LTC Properties, Lithia Motors, and this Craft Brew Alliance. Stuck that one in there just because I'm a big fan of beer and it was a small cap stock. Again, I weighted those all equally. So the reason why I chose each of these companies is because Sonic is actually behind the scenes less of a fast food place and more of a tech company. They invest a lot into their data science department, and so they're able to figure out things like which goods are complementary. So if we offer a discount on milkshakes, will demand for burgers increase at the same time? So in other words, they can sell milkshakes at a loss past 8 p.m., but since milkshakes and burgers are complementary goods, that means people buy them together. So they'll also get a burger at cost. And so they'll increase demand and increase revenue and profit from burgers, even though they're operating at a loss for milkshakes. And so I just thought that investing in a department of that kind would lend Sonic to a lot of growth potential. So that I felt like that was a good small cap stock to invest in. Also, I chose LTC Properties. The reason why I chose this is I actually have some moral qualms about it. So LTC Properties is a healthcare properties trust. That means that they also invest in rehabilitation homes. I don't know if any of you have ever heard of what's called the Florida Swap. But what goes on in the Florida Swap is that rehabilitation homes try to keep patients coming back instead of treating them and curing them, because they know they'll get more insurance money. And as that value increases, as they keep getting more insurance money, they look very successful. So they also profit out on the stock market because their price increases. So with the opioid epidemic going on, the value of this company is increasing because there are more and more people going into rehabilitation homes, and then the rehabilitation homes are planting dealers of addictive substances in them so that people will continue to return. So that's why I thought LTC was a really interesting small cap company. Hopefully it fails in the future. But if you're interested in hearing more about that, NBC has a documentary about it. Lastly, or second to last, I chose Lithia Motors because they're an automobile retailer in the United States, or automotive retailer. And the manufacturing industry for automobiles went down in the United States, while retailers have enjoyed a bit of a spike since the recession. Durable good purchases are finally increasing as of 2014. So that's why I picked that small cap company. And then finally, I did pick the Craft Brewer Alliance for reasons other than just that I like beer. It's really because demand for craft beer is very inelastic. People are willing to pay a much higher price if they know it's a good beer, probably with a high ABV. And so as demand for that good increases, I figured it would be a good time to invest in that small cap company. So really what I'm going to do here is I'm going to do Fama and French analysis on both of these portfolios, and then I'm going to compare the different coefficients, the different R-squared values, all that good stuff. But first, I want to just look at sort of prima facie, how does each portfolio look, broken down by the individual stock return over the course of the years of data I looked at, which were from 2008 to the end of 2017. So you can see here that LAD, which is actually that the lithium automotive company, it even outperformed the larger company, which is Louisiana Pacific, consistently. So I thought that was really interesting. And then since LTC Properties and Sonic are small cap, I expected that they would outperform Louisiana Pacific as well. But it looks like they didn't during this time. I'm not entirely sure of the reasoning behind that, probably just because they're so small that they're still subject to people not willing to invest in them. So secondly, I looked at all of the small cap companies, the portfolio with all small cap. And you can see that the brewing company was a big and positive addition to this group of investments. You can see that in many cases it outperformed other stocks. So it's a good time to invest in craft brewing. And you can see that it looks like brewing performed better than Louisiana Pacific. So that implies that portfolio 2 would actually overall be better than portfolio 1, which would be consistent with Fama and French's findings about small cap and large cap returns. So the data does show that Fama and French's hypotheses are actually only partially empirically supported by the portfolios that I selected. So you can see, first of all, that HML, that's that book equity to market equity ratio, that's actually statistically insignificant, which is surprising because Fama and French thought that HML was more important than SMB, which is the small minus big factor. You can see that the beta, or the portfolio risk relative to the market risk, is highly statistically significant. You can also see that small minus big, or that comparison of small cap and large cap, is highly statistically significant. And this is for the portfolio that was 3 small cap, 1 large cap, all weighted equally. You can see a pretty high R squared value in sort of the mid to low 60s. That's a little lower than I would have liked for it to be, because I have heard of Fama and French explaining up to 90% of the variation in returns, and this is only explaining about 60%. You can see by the F statistic that my model is highly significant, so it is explaining a pretty substantial or reliable explanation of the variation in portfolio returns. So here's the interesting part, is when we compare the regression output of portfolio 1 to portfolio 2. So you can see that the same variables are statistically significant, which is the risk-free and market rate, or the beta, as well as the small minus big, or SMB. However, notice that, I'm going to flip back to the other slide here. Notice that SMB for this one was 0.009, but SMB for the one containing all small cap was 0.008. So that means that the returns are actually increasing less as the small minus big factor increases. So that's really strange, given that I had a large cap investment in my last portfolio, and for this one they're all small cap. I would have intuitively expected that to increase. The other thing you can see is that the beta did decrease in the second portfolio option, which means that, so in the first portfolio, since the beta was less than 1, the portfolio was much less risky than the market as a whole. And for this portfolio, it was even less risky, not by a whole lot, but it is a bit less risky. So that's really interesting, since people kind of assume that small cap companies are riskier to invest in than large cap. But here's one of the other strange things, is that my R squared actually went down to 52%. And the reason why I think that is because I talked earlier about how small cap companies are more subject to risk factors other than that which can be explained by the market. And given that my data is from 2008 to 2017, this was during the financial crisis. So that would mean that the small cap companies had their value significantly diminished by the recession, whereas even though large cap companies had that issue as well, they didn't have it to the same extent. So what I'm thinking here is that the recession actually introduced some noise into the equation, some risk factors that couldn't be explained by HML, SMB, or the beta. And so I think that's why we're seeing this difference here. Again, the F statistic, my model is significant at the 99% confidence level, so pretty confident that SMB and the beta are statistically significant to explain the returns over this period of time. The constant, I didn't go into interpreting that because it's statistically insignificant, but all that means is it gives you the intercept, so it tells you how well the portfolio actually performed in comparison to what the model would predict. So in other words, it tells you how it would perform without, or not taking into account all those other 3 factors that are in the model. So the insignificance of HML does show that Fama and French's observations don't apply to all portfolios. Additionally, it might invalidate Swenson's hypothesis. So because Swenson's hypothesis was that the reason why small cap companies are undervalued is because they don't have much real intrinsic value, which would mean that there's some multicollinearity between HML and small minus big, if HML is a big part of what causes the outperformance of small cap companies relative to large cap companies. Additionally, S&B was lower for their portfolio that included all small cap investments. This could be a result of the 2008 financial crisis introducing some noise, like I said. Finally, investing based on small cap or large cap might not necessarily be the best strategy for these portfolios. The intuition behind why I invested in each of these companies seemed to be a bit more reliable of a predictor than the Fama and French model, which I was mostly looking at S&B to figure out whether I had done the right thing. All right, so leave any questions in the comments underneath, and thanks for watching.